A high salary is often just a high-speed treadmill. Market data reveals a surprising trend where individuals earning six figures frequently struggle with liquidity, while those with modest incomes build massive portfolios through the sheer frequency of their capital movement. This phenomenon is known as the velocity of wealth, a metric that measures how many times a single dollar can be reinvested within a specific period to generate new returns. By shifting the focus from the size of a paycheck to the speed of the reinvestment cycle, it becomes possible to outperform traditional saving strategies by an order of magnitude. This analysis explores how the compression of time and the elimination of idle cash create a compounding effect that traditional linear income simply cannot match, providing a blueprint for long-term financial scaling. Most financial models focus on the gross amount of money earned, yet the IRS reports show that net worth is more closely correlated with asset turnover than with hourly wages. To understand this, one must look at the difference between static wealth and kinetic wealth, where money is treated not as a trophy to be stored, but as a tool to be deployed and recovered as quickly as possible. Consider two scenarios. One person earns $10,000 and leaves it in a high-yield savings account at 4% for a year, while another takes that same $10,000 and uses it to fund a short-term business project that returns just 2% every 30 days. While the first person sees a predictable but slow growth, the second person is leveraging the velocity of their capital. In the second scenario, by turning that capital over 12 times in a single year, the effective annual return becomes significantly higher than the flat 4%. This is the power of the velocity of wealth. It proves that a small percentage return achieved frequently is mathematically superior to a large percentage return achieved over a long, stagnant duration. Real estate investors often use this principle through the BRRRR method: buy, rehab, rent, refinance, repeat, which prioritizes moving equity out of a property and into the next one as fast as possible. Instead of waiting 30 years for a mortgage to be paid down, the investor aims to keep their initial capital moving, allowing one pool of money to acquire multiple income-producing assets in a fraction of the time. But here's where it gets interesting. When capital sits idle, it is not just staying still, it is actually losing value against the broader economy. Economists track the Consumer Price Index to measure how inflation erodes the purchasing power of every dollar held in reserve. If the inflation rate sits at 3%, $100,000 sitting in a standard checking account effectively loses $3,000 in value every year, meaning that stagnant money is actually a liability in a fluctuating economy. This erosion creates a hidden drag on a person's net worth, making it harder to reach financial milestones regardless of how high their salary may be. For many high earners, the trap is the comfort of the cushion, where having a large cash balance provides a false sense of security while their wealth is quietly being devalued by the rising cost of goods and services. By contrast, those who understand velocity ensure that their capital is always tied to assets that appreciate or generate cash flow, effectively outpacing inflation. Whether it is reinvesting dividends or moving profits from one venture to the next, the goal is to minimize the amount of time a dollar remains unemployed in a non-interest-bearing environment. Historical data from the last 50 years shows that equity markets and real estate values typically grow at a rate that offsets currency devaluation, but only for those who are actively participating. Sitting on the sidelines while waiting for the perfect moment is often more expensive than a mediocre investment that is made immediately and managed actively. The data tells a different story when we examine how the world's most successful corporations manage their balance sheets. Fortune 500 companies do not keep billions in cash just to have it. They measure success by return on invested capital, or ROC. This metric tracks how efficiently a company turns its available money into more profit, emphasizing that the speed of the business cycle is just as important as the profit margin on any single product sold. A retail giant like Walmart or Amazon thrives on high inventory turnover, meaning they sell and replace their entire stock several times a year. This allows them to operate on thin margins while still generating massive total returns because their money is moving at a velocity that traditional smaller retailers cannot replicate. Individuals can apply the same corporate logic by looking at their own personal balance sheet as a series of cycles. Instead of viewing a home as a permanent residence, some view it as a store of equity that can be tapped through lines of credit to fund other ventures, effectively turning a dead asset into a source of kinetic capital. By utilizing tools like automated dividend reinvestment plans or DRIPs, investors ensure that every cent of profit is immediately put back to work without human intervention. This eliminates the friction of decision-making and ensures that the velocity of wealth is maintained even while the individual is focused on their primary career. But mastering velocity requires more than just moving money. It requires understanding the specific mechanics of the spread. The multiplier effect occurs when the frequency of compounding increases, even if the total amount of capital remains the same. If an investor earns a 5% return twice a year and reinvests the profit, they end the year with more wealth than someone who earns a flat 10% once at the end of the year, due to the effect of compounding the mid-year gains. In the world of professional lending, banks utilize this by lending out the same dollar multiple times through fractional reserve banking, creating a velocity that powers the entire global economy. While individuals cannot print money, they can mimic this by using low-interest debt to purchase higher-yielding assets, capturing the spread between the two rates. Data suggests that the most successful wealth builders focus on assets with high liquidity, meaning they can be bought and sold quickly. This liquidity is the fuel for velocity. If a dollar is locked in an asset that takes 6 months to sell, its velocity is capped, whereas an asset that can be liquidated in seconds allows for a near-infinite number of cycles. The goal for anyone looking to scale their net worth is to identify the bottlenecks in their financial life, where money sits for too long without working, and engineer a system that keeps it flowing into new opportunities. This transformation from a saver mindset to a velocity mindset is what separates the average earner from the truly wealthy. As the global economy moves faster than ever, the ability to redeploy capital with precision and speed has become the ultimate competitive advantage in personal finance. Ultimately, true wealth is not determined by how much is earned each month, but by how quickly and effectively those earnings are recycled into the next growth engine. If this changed how you think about the power of liquid assets, the next video breaks down the specific vehicles used to maximize cash flow turnover.